Broadcast is now starting. All attendees are in listen-only mode.
Good afternoon or good evening. Can everybody see my screen and hear me? Wonderful. Let's go ahead and get started. There was not phrased very friendly, but there was a comment regarding the way that we present Elliott wave analysis and discussing things in terms of probability and what the preferred paths are. And I think that it's important for us to take a minute to talk about how we approach Elliott wave analysis in general by degree. And we've talked about this before, but it might have been a while. The Elliott wave works as in fractal in nature. So we rely on seeing the same patterns and those patterns following specific rules broken down within larger degrees. And then it keeps going down smaller and smaller. And in a bigger level, you can keep getting bigger and bigger in terms of the degree. So we can zoom out to a monthly chart and see the same series of 5 up, 3 down emerging at a huge millennial degree or grand supercycle. And then we can drill down and look within that and see in each third wave, there's going to be 5 waves inside of it, unless it happens to be inside of a diagonal. So when we talk about terms, when we discuss Elliott wave counts and say, this is what we would prefer to see, or this is the ideal, then we're saying based on the standard rules, the general guidelines that Elliott wave gives us for how things should progress inside another wave, this is what that path should look like. But the smaller and smaller you go in degree, the more potential you get for variability in that pattern, particularly when you're dealing with the consolidations in between the impulsive or motive wave runs, as they're called. So I think all of the analysts are very much on the same page in terms of the larger degree structure that we see off of the 2009 lows. We have 5 waves up for wave 1 at primary degree. We have 5 waves up for the wave 3 at primary degree. We have this very large correction, which most people are counting as an expanded flat. Margot, maybe there's an issue with your audio. It seems everybody else can hear. We had flat consolidation into the March 2020 low that we're counting as a primary wave 4, and we're still very much inside a primary degree wave 5, continuing to target new highs that has certainly not yet topped. When we go into that, that's where we start to see a little bit of difference between how some of the analysts are counting maybe a larger wave 1 up to here instead of what Garrett and I are counting as a wave 1 into the June high. But we're still looking for the same 5 wave structure for that primary degree wave 5. And inside that move, we're still counting it as an impulse and looking for 5 waves inside the third, and then another 4th and a 5th wave up before we completely top. So then when we start drilling down further into the minor degree, or maybe even inside that minor degree, that's where things get a little bit less cut and dry, and there's more potential saying, well, maybe this is an extension of the minor degree wave 3 still, instead of the B wave that we were looking at last week. So when we say this is what we would like to see, or this is the ideal support that needs to hold, those are the way that we talk about Elliott wave. If you're looking for a very clear cut saying this is exactly what it's going to do, then you need to go find somebody who has a crystal ball. All we can look at are probabilities. And we have a lot of really good rules and a lot of guidelines and a lot of track record of the market doing, what we think that it's going to do within that framework, and seeing those patterns continue to play out, that we're still going to approach that as our primary way of viewing markets. A week ago, when I left off with you guys, we were right about here, looking at a potential topping for a B wave inside a larger consolidation. We can talk a lot about what we would like to, what degree we would like that consolidation to count as. But off of the October low, we have what looks very clearly like a corrective structure. We got a little extension. We had a possible start to a pullback, and then further extension from there. We can count this as 5 waves up from that little jog on the 22nd, and then up to the high that was made today. We do have a higher high than we made in September. B waves are allowed to make higher highs. It's called an expanded flat. Tiff, as far as fibs, we can talk a little bit more about the fib extensions for the third, but the yellow fibs here are going all the way back to the primary degree wave 1 and wave 2. So the third in that count topped at the 176.4% extension. It got an expanded flat where the B wave, or the X wave in this case, made a substantially higher high up to the next fib, the 200%, and then came back down for a nice flat consolidation into expected support for the fourth wave. When we get an expanded flat, which I was starting to talk about at the smaller degree on the 30-minute chart, it implies that the underlying structure is still very, very bullish. And so getting further extension well past the 238 extension, and maybe even past the 2618 extension for our primary wave 5, is not at all unorthodox when you have such strong extension for the third, past normal fibs even for this third based on the yellow fibs. You know, if this had topped at the 1618, we'd be looking for a larger top in the, you know, the 200%, or maybe even the 2382 for the primary wave 5. It got further past that, and then the B wave, or X wave in this case, got even further past that. So, you know, we can look at normal fib extensions that we would see for a primary degree wave 5, but also we want to look for the agreement at the smaller degree and say, okay, you know, yes, this has satisfied minimal requirements for a primary wave 5 off the March 2020 lows, but the subwave structure doesn't look at all complete for the indices, a lot of individual stocks, and much of the market sectors. There are some things that Garrett and I certainly do see that look like 5 waves up off of the March 2020 low completing, and those are things that we're not very bullish on. So similar to that larger structure that we were looking at within the primary degree wave 4 that we saw back from the 2019 and early 2020, we have a higher, what counts best as a higher B wave here. We can talk about the potential that Avi's counting as far as a 5 wave up move that needs to hold a fourth and then get a 5th wave and then would need a consolidation after. I would be looking at that as an extension of this wave 3, as we talked about last week, not yet as the start of a 5th wave up, because we only just got a little bit past the 100% extension of our intermediate degree parentheses wave 3, and we know that the 100% is the most normal fib extension for the third wave of 3 inside Fibonacci pinball, but another valid extension is getting close to the 123.6%. So that would look more to me, because of the size of the consolidation that we got, as an extension of the minor degree wave 3, as opposed to wave 1 of this 5th wave starting. But either way, if we were to hold the 4470s and then get a 5th wave up to the 4650s or a little bit higher, we would still be looking for consolidation at the very least as a wave 1 and a wave 2, if this were the larger degree 4 already and this were starting a 5th wave up. If we are looking for a C wave down, though, the measured move for that C wave based on the top that was hit today is 4328.50. But that does not give us a lower low. It is also possible in Elliott wave for the C wave not to make a lower low than the A wave. It's called a running flat. It does happen quite often when you have an expanded flat. Sometimes it's also running, because a 100% extension is a common fib extension for a C wave. in a flat structure. And if the B wave makes a higher high, then mathematically the C wave, if it's only going to get the same measure of the A wave, cannot make a lower low. But 1236 and a 1382 are also very valid fib extensions for a C wave. We'll be able to pinpoint that target a little bit more once we have what looks like a wave 1 and a wave 2 in place inside that potential C wave down. Also, as we discussed, the ideal target for the fourth wave is in between the 236 and the 382 retraces, as well as when we zoom out, we can talk about some of the other guidelines. One of the other guidelines is that your fourth wave will find support inside the fourth wave at 1 degree smaller. So that's the fourth inside the previous third. So that's one area that would extend from about 4230 down to 40.4 or 4040. So that's one area of support that we would look for in terms of the guidelines for a fourth wave. And we see that there is nice confluence there with the 4200 region or 4190 and the 43980 as the, the 236 and the 382. Another guideline region of support for a fourth wave is that in Fibonacci pinball, when your third of third hits the 100% extension, the fourth pulls back to the 764. That's at about 40.4037. So again, more overlap and confluence with this is an ideal region of support. But another thing that we do look for is that usually an expanded flat, as we talked about last week, an expanded flat is often not just the A wave of a bigger consolidation. Usually when you have an expanded flat, that expanded flat is all the consolidation that you get at that degree, and then you get a move up to another high. So that's why I would like to see the C wave down here stretch further below the 4200 region, because as we talked about last week, if we can get down under the 4200 region and get a little kiss of that 200-day moving average and a little bit closer to at least a 23.6% retrace of this wave 3, then I'll have a lot more confidence in calling this all of that wave 4 at minor degree. And then we're going to be looking for a significant bottom in the next swing, targeting the 5133 region for the 5 of intermediate degree wave 3. Hopefully that answers most of the questions on the S&P. I want to move over and take a look now at the RSP, which we looked at last week. This is the equal weight version of the S&P 500. And as mentioned last week, I think the subwave structure, we'll zoom out here and look at the daily. We can see the daily, it counts very similar to what we were looking at on the SPX. We have off the 2009 low, 5 waves up for primary degree wave 1. You can count an expanded flat here as well, or I do think the S&P might count, or the RSP might count a little bit better with the February 2020 high actually being the top of the primary wave 3, and then the drop down, instead of being the Y wave of the 4 of an expanded flat, that's just all of a very sharp drop for the primary wave 4. I think the fibs work out a little bit better that way for the RSP, but very similar structure off of the low for its primary wave 5. But more clarity, as we discussed, to the 5 waves up into the June high as wave 1, and the retraces parentheses wave 2. And then a 1, 2, 3, and still running into resistance there at our 100% extension of intermediate degree wave 3. And again, if this is going to hold as a small fourth and get a 5th wave up, it'll still be in our target box, which we can extend over further in time here, for the same minor degree wave 3, just at a slightly higher extension, closer to that 123.6% extension of the parentheses wave 3, and will still be due for all of the wave 4 at that point into the ideal support region that we are looking for that 4th wave. If this is the B wave of our expanded flat, then again, it would be preferable. The 150 region is a 100% extension based on the high that was hit actually yesterday or 2 days ago is when that high was made in the RSP. It's been leaking lower, diverging from the Nasdaq and the S&P the last 2 days. The 100% extension is the 150 region, but again, getting under 147 would allow me to have more confidence at calling this all of the fourth wave versus just looking at this as extension and maybe needing another B and a C wave before we get into a more reliable support region for a fourth wave of that degree. But an expanded flat, particularly if this takes a little bit longer in time, maybe if it heads closer to that 147 to 145 region into the beginning of December, that would certainly be pretty reliable for all of the fourth wave, even though it's shy of our ideal green target box. And then our fifth wave of intermediate 3 is still going to be targeting that 187 region. If the RSP holds the 154s and then gets that fifth wave up to the next fib closer to the 163 region, then we're still kind of halfway in between that 1236 here, but we would be able to potentially look for the fifth wave from here after a fourth to target all the way up towards 209. But this 187 region still has nice confluence. Also wanted to take a look at the QQEW. This is the equal weight version of the Nasdaq. I can certainly squeeze in all of the subwaves like I have in the Nasdaq to count all of the intermediate degree wave 3 complete. But the QQEW, as we've been following it in stock waves, still does allow for this to be an ending diagonal off the March low for the fifth wave of intermediate degree wave 3, getting one more C wave up if it can hold support into the 112.50 region. The interesting thing here, though, is that from this move that did not actually make a higher high like the Nasdaq did earlier today, could still count as a B wave in the start of the larger 4. So we have an A down and a B wave up, and could be starting a C wave down, which would target maybe this region. That could even still be just an A wave. But what I found very interesting was, despite the Nasdaq being up significantly earlier today, skewed largely by Google and Microsoft response to their earnings, the QQEW was never green today. It was in the red all day. So, one of the reasons why we do like to look at that is because it smooths out some of those distortions that you can get when just a few names are pulling the market in one direction. I mean, those few names can pull the market for extended periods of time and cause positive feedback loops. But sometimes it's good to look and see what's actually going on under the tape. Speaking of the Nasdaq, let's pull up our larger degree chart here. I have that extension of the fifth wave of the fifth wave of the fifth wave of parentheses wave 3 here is an alt on blue on my Nasdaq chart. My primary on the actual Nasdaq is that the third did top. We did get a nominal higher high today. We pretty much did a double top before we started the reversal. It has not yet confirmed as the top of a B wave, but that is certainly my preference. I would have rather seen this hold a little bit further below, because it's, again, this is going to be a rather small consolidation, even if it drops closer to the 13,000 region, to reliably count as all of the intermediate degree wave 4. But certainly, even if we were going to be stubborn and say this really has to be only an A wave, a clear 5 waves down into the 14,000 region, maybe even 14,385 to 13,900, Any clear 5 waves down as a C wave is going to be a very, very good opportunity for a long, even if that turns out to only be a B wave bounce. A normal B wave bounce from there could easily be a 7 to 10% rally. You're very welcome, Ken. We'll jump to the IWM in just a minute. CPS, are you talking about, can this be short for the week? In terms of the move off the high, we have made a pretty nice looking reversal, which when we zoom in, when we zoom in a smaller time frame, does certainly look like a possible 5 waves down, but we need a little bit more than this to confirm. Certainly if we get a corrective bounce back up to maybe 15,660 tonight, that could set up for another measured move down towards the 14,470s, 450s, and then that could be part of a larger 5 waves down forming. But as we're looking here, if we're getting more of the extension closer to a 1382 extension for the C wave down, then probably the 15,000 region is going to be our general target, 15,200 to 15,000 for 5 waves down as wave 1 of that C wave. If you wanted to be adventurous, you could certainly look down with stops at that prior high. Working off of a double top is not a bad place to get speculative for a C wave down. 5 waves down for wave 1 of this wave 1 should target maybe about the 15,400, 15,300 region. So if you wanted to be a little bit more conservative, maybe waiting for 1, 2, 3, 4, 5 waves down as that wave 1 and then a wave 2 bounce. And that would be an even better risk reward setup for some downside action. All right, let's move on to, actually, before we go to the Russell, let's take a look at the Dow. The Dow, I think, counts a little bit different. We could squeeze in 5 waves up to the June high, but I think the Dow works better as the September high being the 5 up for its intermediate degree wave 1. So that puts it behind the count for the S&P and very much behind the count for the Nasdaq. But in the shorter term, it's still only in the minute degree wave 4. We still have a very clear corrective move up that started as 1, 2, 3 waves up, and then a pullback, and then what could count as maybe either stretched out 5th wave of the C or maybe an ABC move. So that's where this blue comes in. But again, that would probably count better as an extension if this is 1, 2, 3, 4, and 5 waves up. I would see this more as extension of this wave 3 as opposed to it being wave 1 of the start of a bigger 5th. From there, the support, though, would be the 34,700s as a possible wave 2, and then back to the same 33,600 to 33,000 region if this is an extension of 3 for the wave 4 again. But also another thing that held a little bit less of an extension past the prior top than the S&P, and does clearly look like it can be starting a C wave down if that recent high holds. And then moving on to the Russell. The Russell, as we spoke about, am more inclined to count the end of August as all of its minor degree 4th wave because it topped in its minor degree 3rd back in March and has a very drawn out consolidation already. The structure off the low, though, really does not give it a lot of room to hold on to that count if it is an impulsive start to the 5th wave of intermediate wave 3, which is targeting the excuse me, the 2800 region. So we're going to zoom in on that structure. You can see our fifth wave up of intermediate 3 targeting its 1382 extension at that 2800 region. If this is 5 waves up for wave 1, a deep retrace for wave 2, another 5 waves up for the wave 1 inside of the third, and then another deep retrace, and then another leading diagonal is 5 waves up for yet another wave 1. We can be getting a deep retrace, but we really should hold the 2200 region. And the more nested you get can be setting up for an explosive move. But at a certain point, more 1-2-1-2s inside of a structure does not make the structure more reliable. It makes it less reliable. That means that it had a 1-2, a 1-2, and it had an opportunity to really break out, and it decided not to. So if it's going to hold 2200, great. My concern is that certainly if the 2200 region fails, as we discussed, it can be setting up for a drop in an even more complex version of our minor degree fourth wave. And that's just because, you know, if everything else is dropping, it's harder for the small caps to move against the grain. They were able to consolidate when everything else was pushing higher, but I think the opposite is harder. They can front run the other indexes, but it is very hard for them to really go in completely opposite directions to the upside when everything else is dragging the market down. Just the nature of where most selling occurs when the market is having red days in general. So if this is a more complex structure for the fifth wave up, we can be working on perhaps an ABC up for wave 1 of an ending diagonal. If that is the case, we really should hold as a fourth wave very soon inside of the C wave up for that wave 1. So we are running out of support. The more bullish, I can go ahead and add that 1 degree smaller 1-2 inside this green wave 3, which if that is the case, it would push the target up even higher. But again, I can't see that as the most reliable count at the moment, particularly not with the way that this reversed from the prior region of resistance here. Yes, Tiff. My primary analysis is that the S&P is pointing to a C wave down off of the recent high. The alternative to that is that it holds support in that in this 4440s region. And then from there, if that's a clear ABC consolidation holding the 4440 region, then that would set up for a move towards 4700. All right, let's move on to oil. There was a request to look at the larger degree. I think the larger degree is a little bit hard to look at on a daily chart because of how extreme that final drop was into the April 2020 low. But I'm counting the initial move off of that and into the later April low as the intermediate degree 1-2. So in that count, the low that we hit in November was the fourth wave inside the third. Even though this is pretty small, it counts best as all of the fourth wave consolidation, and we're working on a fifth wave up. Inside that fifth wave, pointed out that we were coming into resistance from the 1618 and then an extension to the 178.6 as 5 waves up inside the third. That's a normal fib. And we've reversed from there and can be consolidating in our minor degree wave 4 inside the larger parentheses wave 5. I do think that this can easily stretch past normal fibs. Oil in particular, similar to silver, tends to get extended fifth waves, and this would be a fifth wave of a fifth wave. And also stocks in general, and particularly commodities like oil, do tend to gravitate towards some of those nicer round numbers. And so extending from the 95 region up towards 100 or maybe even 105 certainly seems pretty plausible. Again, once we have a clear ABC consolidation and a 1-2 start to the fifth, we'll be able to pinpoint a top target or a topping region even more. But I do think that we can certainly see a move up towards 95 and would not be at all surprised if that extended towards 100. Moving on to natural gas. This could be our B wave inside the fourth, but it does look like 5 waves up. This is not reliable for all of a fourth wave. Certainly not as a fourth wave in a diagonal. I have a really hard time counting this as 5 waves up here for wave 1. But if that is 5 waves up for wave 1, then it's possible that this is maybe still just the third of the third in an impulse, and this is starting the 5th wave up in an impulse. I can add that as a more bullish alternative here, that this could be 5 waves up. So a clear corrective consolidation that holds maybe the 550s could be set up for a more bullish extension that could take natural gas all the way up past the 950 region. My preference would still be to count this as just a slight extension of the A, B, C up for a B wave, and to get a C wave down closer to the 420 to 390 region. I think that makes for a much more reliable base for a move up in natural gas, but can't ignore this possible 5 waves up here. So if we snap this to the low, and this is topping, we can get a general support region. 570s to 530s is our normal sweet spot of fib support if this is 5 waves up topping here. Mom Chili, the equal weight version of the S&P is RSP. So SP is in S&P 500. RSP is the ticker. All right, that is natural gas and oil. Let's move on and take a look at our metals. As we talked about last time, holding this March low from 2021, looking for a 5th wave up to the 2200 and possibly extending beyond that if we get more of a blow off top that we sometimes see in 5th waves of metals. And this could be the 5th wave up of this 5th, going all the way back to the December 2015 or January 2016 lows. I'm counting this 5th wave up off March 2021 as an ending diagonal. That means that the 3rd wave, well, all of the subwaves are ABC moves. I'm looking for more normal 3rd wave extension though, even though we got such a deep, or because we got such a deep wave 2 retrace. Looking for our 3rd to head to more normal fib extension, which means that 1920s can still be just the A wave of that wave 3. Inside that structure A waves we know can be either 5 waves up or 3 waves up, but more commonly A waves are ABC moves themselves. And so we're looking at an A wave up of the A wave off the August low for our intermediate degree wave 2. And the structure inside the C wave seems to be filling out as an ending diagonal. That's an ABC up for the C wave, for the wave 1. And we're working on an A and a B wave inside the third of that C wave. It is possible that that bottomed at the 1782 region. Actually was looking for potentially one more low from here, and it looks like that might have truncated. So we have an A, B, and a possible 1, 2, 3, 4, 5 waves down in the micro at the C wave that just failed to get that 5th wave of the micro C just under the 1782 region. We do not yet have clear structure off of that low to confirm the start of our C wave up, but that is our general support region in the 1780s, looking for a move up towards the 1840 to 1860s as our C wave of 3, still inside that larger C of 3. And as I keep pointing out in the metals service, we continue to look very constructive off of the 1720 low that we held as the AB structure, or maybe even a 1-2 structure inside this A wave off of that parentheses wave 2 low. Looking at silver, silver can count as a similar 5th wave, just probably 1 degree smaller than gold, but also it made a lower low from its prior, from its March low in September. So we're looking for a new start off of that September low in silver. So far, it's filling out as a nice impulsive move. We have 1, 2, 5 waves up inside the 3, and a nice ABC consolidation, holding ideal support for a 4th, and trying to start a swing up as the 5th wave in that move off of the low. After this completes 5 waves up, looking like it's targeting the 25 to 26 region of resistance, 2550 to 26 region of resistance. We'll want to see an ABC consolidation, ideally holding the 23s to set up the next larger magnitude swing or measured move from there. The metals and mining stock service is very bullish on platinum. We got deeper than we wanted to see we were previously counting this as a 1, 2, and then the A and the B structure inside the third. We knew to expect to move down from the May highs in a deeper B wave. We got an extension of that was fine, holding the 1,990 region, but then the further extension lower and failure to get anything clearly bullish as the start of a C wave off of that had a shift to this alt count of a larger diagonal, where this was ABC up for a larger primary degree wave 1. This was an ABC move down that held a 50% retrace for the primary wave 2. And even if this primary wave 2 is not complete, we're looking for at least a larger ABC move up for a B wave in a wider flat for that primary degree wave 2. Off of the low, again, we're looking for an A, B, C up at the intermediate degree inside that primary wave 3. And inside that A wave, we're looking for an ABC move up as well. And so inside that A wave, we're looking at the potential for an A, B, C up at the minute degree. And inside that minute A wave, we are looking for a possible A, B, C up at the minuet degree. And we can see a possible sub-minuet ABC up already and pulling back in our B wave here. So ideal support is the 1004 down to the 960 region. This could be all of the B wave completing at the very top end of that normal fib support zone that we look for. But we have to allow for this to be just an A wave, get a B wave bounce that maybe runs into resistance in the 1060s, and then comes down as a wider flat towards 980 or 960. So if you're looking to scalp this using platinum futures, That's a big contract. Be careful. You can look at a speculative move for a bounce in this support region here for at least a bounce up towards 1060. But be very careful because this can easily extend lower in the B wave still into November. But if you're playing this for the larger degree using something like PPLT, the risk reward off of this September low is phenomenal for the duration of that move longer term. Let's check in with copper, and then we can take a look at the almighty dollar, and then we should probably look at the GDX as well. Copper, I warned that if this was going to be part of a wave one off of this less reliable fourth wave, we needed to hold similar support as the possible yellow 4, which could be A, B, and the fourth wave in the C of this B wave here. But the risk that we've been discussing in the mining stock service is that the B wave could have completed as a WX and then ABC for a Y wave. And this is the start of a C wave down. Normal support for that C wave to give us a much more reliable parentheses wave 4 is the 370 to 360s. That would really be ideal in my view. If we drop this down to if that was the top, our 1236 fib extension gets even closer to that 38.2% fib retrace of our third here. This can still be the fourth of a leading diagonal, but I think that is quite a bit less reliable now with the drop deeper. All right, moving on to GDX. Here's my good tab. Let's zoom in. Oh, let's actually zoom out for a minute. So GDX, as we talked about last week, Garrett and I are counting this as a larger diagonal with the move up. I think actually Garrett might be still counting GDX and a few other things is still allowing for this to be a third and a fourth inside the primary wave 3. But the ideal target is still north of the 60 region. I like it as the A and the B with our 100% trying to get us closer to the 74 to 81 region. And this being just the wave 1 of wave 1 in the start of our intermediate degree C wave up off of the October low. It is not yet confirmed as a bottom, but we do have a very solid 5 waves up off of that October low in both GDX and GDXJ, as well as a number of our individual mining stocks that we follow regularly. We're working on getting more of an ABC retrace into our ideal fib support zone, which would be just under 32 down to the 30.6 region is ideal. Anything close to 32, I'm going to be happy with. That will easily count as 5 waves up and a 3-wave retrace. Even if we only get a B wave bounce from there and then come back down as a wider flat, I'm still fine with that. But 3 waves down to a higher low is a good opportunity to trade for the third inside of wave 1, which can easily be targeting the 3940 region. And GDXJ is pretty much identical. All right, let's look at the dollar. And then we can look at bonds. And then if there are any other questions, ask now before I decide to go have dinner with the family. So I do think that we could have hit a pretty significant top, at least significant for a period of time in the dollar back in March of 2020. I count 5 waves down from that, which I'm labeling as an A wave and a corrective ABC bounce into a 38.2% retrace, setting up for a possible measured move that takes the dollar down to the 81 region. I also like the way, not that I look for correlation, but I do like the way that this potentially fits with opening the window up for a similar pattern to unfold on GDX. The wave 1 of that C wave should target the 90 to 89 region as 5 waves down. And we do have a pretty decent little start. This doesn't really count as a clean impulse, but a nice little move off the high. So if our 94.55 can hold, I'm definitely looking down for the dollar. JR, the Bank of America and PLTR and AMC we can discuss tomorrow in the mining stock service. I will take a look at bonds, Glenn. Before we look at TLT, I think it is, as I posted in the markets bond section in on EWT earlier today, I think it is more prudent to look at the 30-year Treasury closer than any of the other Treasury bonds. I think the structure is a little bit more clear, and I think it has the bigger weight on the entire space. Zooming out to the larger structure, as we talked about last time, we are either looking at the possible start of a primary wave C off of the March low, but the 10-year did already break this low. Or there is risk still of trying to get at least a nominal lower low under that as the orange parentheses, as the fifth of the orange parentheses C wave. We didn't get 5 waves up off the low, but if our 156.30 level holds, this can be an A, B, and working on the start of a C wave up for what looks like it would be wave 1 of an ending diagonal for the C wave up in the larger cycle 5. When we zoom in on that structure, we can see the possible low that we got in March for the B wave, the A up and the B down, setting up for a possible measured move for the C wave up, targeting 171 to 175 for normal fib extensions as that potential blue wave 1, but also the risk that this is an A and working on a B wave inside that final drop for the orange 5 of parentheses C. So we don't yet have 5 waves up off the low. We have only 3 waves up. We can get a little bit higher in this B wave. If this is A and B and a C wave, that C wave can get a little 4th and a 5th wave up, closer to 162s. But there is certainly a risk here of setting up for a short-term drop down towards the lower low under the March low. When we look at the similar on the 10-year, we see that we are already significantly under that March low. So this did not hold as the B wave there. And in our 5th wave of the C, we can be further along, and this can be a much smaller corrective bounce and still drop another time lower to get to 129 or maybe even 128. When we zoom out and look at this at the larger structure on the 10-year, on TY, which is also ZN as opposed to ZB, which is the 30-year. On my system, it's US and TY. I don't know why, that's just IQ feed. We see that we still have a lot more room for our B wave to find support, but easily can drop down closer to that 50% retrace next, and then start wave 1 of the C wave up. So now with both of those structures in mind, we can take a look at TLT, which as I've spoken about before, TLT is a combination of the 30-year and the 10-year to get a 20-year plus duration of Treasury exposure as an ETF. So it skews from the actual bond prices. And I think it's important to understand that you're dealing with an ETF that is meant to try and track 2 things that are different and blend that together. So you're going to sometimes get a distorted view. In TLT, this could still count as the 4th wave in getting 1, 2, 3, 4, 5 waves up for wave 1 of the C. I think it probably, if it is working on wave 1, it's working on the same A, B, and C wave up for the blue wave 1 that the 30-year is. That relies on holding the 142 region. And there is certainly a risk that this was an extension of that 4th, and this is an A and a B wave, and it tries for at least a nominal lower low close to the 132.60 region for that C wave of the B. Any other questions, guys, or should we pause it there for the day? Oh, sorry. Wen asks, you use some other technical indicators to assist EW analysis. Which do you think are more reliable? I am not an avid student of other technical analysis. One of the things that I do like is I like how Elliott wave can give you a window into what might be going on with regard to other schools of technical analysis. I'm trying to find a good example. We'll use this. So say we get a leading diagonal structure for our wave 1 here off of a lower low. So that's where you get kind of a choppy move up, and I use blue a lot for my diagonals as a color code, not necessarily as an alt count. But that would be an ABC move up for wave 1, and then kind of a deeper retrace, and then an ABC move up for the wave 3, a deeper retrace, and then an ABC move up for wave 5. So, for example, if we got our lower low close to 128, and then we got an ABC move up for wave 1 of a leading diagonal for wave 1, that would look very much, this 1-2 would look very much like an inverse head and shoulders, where you have a shoulder here, a lower low for the head, a move back up here to the neckline, and then another shoulder here. So Elliott wave gives you a way of categorizing that and fitting it into even larger structure, and calling it something part of a bigger piece. But that traditional technical analysis of looking for that inverse head and shoulders as significant of a bottom and then looking for a measured move up would fit very nicely within the context and framework of Elliott wave. In terms of other technical indicators, I do really like Carolyn's moving average, which I have that on the micro counts tab. I really do like Carolyn's 8 and 34 moving average crossovers at different time frames. And so I keep a tab for ES and a few other charts where I have that on there, and I watch for that crossover and give it a little green or red indicator when those cross. I also, I'm kind of, maybe it shows that I'm not a millennial, but I do also like stochastics. But I'm definitely not as skilled at using MACD and other things as people like Harry Dunn have shown. But I do show those on my charts and keep an eye out for divergence and some other structures that Harry Dunn has said, hey, keep an eye out and look for when MACD is doing this. All right, we'll go ahead and end there, and I'll start getting this converted and uploaded for you guys. Have a wonderful evening.